If you haven't looked as we head into the election, can you guess which one of the 11 sectors in the market has been the hottest over the past month? I'll give you 2 hints. 1, it was the only sector to end up being positive in October, and 2, it's not technology. I'll give you a few seconds to think about it, and then we'll talk about what it could mean for you going forward. Welcome to Healthy, Wealthy, and Wise, the channel where we talk about what we can invest in for improving our financial health. I want to first thank the community for checking in again with me this week. And for everyone else, my name is Kevin, and I want to welcome you here for the first time. We've been talking a lot about IPOs recently on the channel. However, on the eve of the election, we don't have a single US company on the calendar for this week. So instead of having our IPO This Week episode, I figured we'd do a No IPO This Week episode and talk about the market in general after a pretty rough October. And how I came up with today's topic was in taking a more in-depth look at what the market actually did last month, and in doing that, I noticed that only one sector was up while all the rest were down. And I thought it could be an interesting discussion that we could have where you could share your thoughts in the comments on what you think it means or doesn't mean, and of course, I'll do my part and share my own thoughts in the video. But up front, just know I'm not a financial advisor, and while my videos are meant to be informative, they should not be seen as a recommendation for you to take any action. You should always do your own research or consult with your own financial advisor when making any investment decision. Okay, let's get into it. For the visuals and data, I'm going to use the SectorSpider.com website, not because I have any affiliation with them, but because they have easy to use tools and nice graphics to look at. So for those of you wondering what the 11 sectors of the S&P are, let's quickly go over them. First, we have communication services, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, materials, real estate, technology, and utilities. Most of the sectors are pretty self-explanatory, so I'm not going to go over them. But if you want more details, you can go onto the website and click over each sector for a definition and see what companies are included in them. The ones that might be a little confusing are the consumer discretionary, which include things you want or have extra money to buy, but don't necessarily need, like that daily Starbucks caramel macchiato, as opposed to consumer staples, which are the things you actually need, like food and prescription drugs. Maybe that's clear to you, but back in the day I wasn't so sure myself, so I figured I'd just clarify that for you. So anyways, back to my initial question. What sector is the one you think did the best in October? And I already told you it wasn't technology, so you only have 10 to pick from. With the surging virus cases and the beginning of the flu season, did you say healthcare? That would be a good guess, but if you did guess healthcare, well, you would be wrong. Sorry, and alright, I won't drag this out any further. It actually was utilities. While the S&P was down about 2.8% for the month, the utility sector within the index was up just over 5%, the only sector in the green which you can see on the screen. Now that's the data, which is the easy part, but why? What does that mean going forward? Again, any thoughts you have, please share in the comments. As for what I think, it could, and I say could because I can't predict the future, but it could be a worrisome sign that investors are going into a defensive posture because they are expecting some rough times ahead. Historically, a move into utilities is made when there is anxiety over the economy, particularly when there are recessionary concerns. And if you think about it, it's easy to see why. When people are losing their jobs, they can stop taking vacations or going to fancy restaurants, but they're not turning off their water or electricity. And in some ways, when they're home more often, those utility bills can even go up because they're using their utilities even more. Often you hear about the cyclical stocks like those in the consumer discretionary sector, where when the economy is strong, where jobs are plentiful and wages are good, those stocks outperform, but when the economy takes a turn for the worse, those stocks can get beaten up much more badly than stocks in the utility sector, which just seem to plug on, slowly but surely. I say slowly because in general, the utilities are closely regulated, which prevents big-time revenue growth, yet I say surely because they have advantages in having less competition in a specific market, unlike most other industries. Another reason investors will go into utilities is for consistent dividend income, and they do this more so when the economy is struggling and interest rates are low. When rates are low, typically as a response to macroeconomic conditions being stressed, an investor can get more income from dividends than from bonds or money market accounts. And then typically when the economy recovers, interest rates will generally go up to prevent inflation, and then investors will leave the utilities because they know they can find higher returns elsewhere. So that's a couple of the main reasons as to why people go into utilities. Now the big question is why now? And just as importantly, how long will this trend last? Obviously the economy has been under duress since March, yet year to date, utilities were still down over 3% as of this weekend, whereas sectors that typically do well with a good economy were higher, including that consumer discretionary sector. But the markets rebounded strongly after that initial market crash, probably stronger and quicker than any of us predicted. Much of that was due to the unprecedented action from the Federal Reserve and the stimulus from the CARES Act, which included things like the direct payments, the enhanced unemployment benefits, and the payroll protection program for small businesses. And of course, the overall belief that once the virus would be under control, either by a vaccine or effective treatments, things would go back to normal fairly quickly. But the sentiment might be changing. Stimulus measures such as enhanced unemployment benefits have run out while millions of people continue to be out of work, and it's been months where Congress hasn't been able to come up with and agree on a new bill. And with a rise in cases of viral infections, there are concerns more lockdowns could be coming, such as is starting to happen again in Europe, which will not only further pressure unemployment, but entire industries like travel and dining, including small businesses that could be driven into bankruptcy. There's also a belief from many economists that the Fed only has so much left in its toolbox to work with, and that congressional action is what's needed most, and that, as I said, hasn't happened. And of course, there is the uncertainty of the election and how that affects further stimulus. And I say up front, these aren't political views because we don't talk about that on the channel, but it's about my assessment of the potential results and what it could mean for the economy in the next few months. The way I see it, there are a few things that can happen, and most will serve as a headwind against the level of stimulus that Wall Street is looking for. One is if there's a prolonged vote count to determine the presidential election. If that happens, then that's time that won't be spent focusing or working on a stimulus plan. And beyond that, the uncertainty of which party will be running the country will spook the market. After that scenario plays out, or even if the results are known quickly, the question will then become who wins the presidential election and what that could mean for a stimulus boost to the economy. If Trump wins and Republicans continue to hold the Senate, there may be only the lesser stimulus package on the table, the kind that the Republican Senate has already been trying to get, but one that the market may not be satisfied with. And that's even if they could still get the likely Democratic-led House to agree. And the Republicans could also look at a win for them at the polls as a vindication that they've done enough on stimulus that the majority of the country agrees with them, and so there isn't a need for any further significant stimulus. On the other hand, if Biden wins, it would be unlikely that there would be any significant stimulus that would be passed until he would take office, and even that would be unlikely to happen on day one. And of course, even if he wins, there will be issues with the Republicans in the Senate because even if Democrats would gain the majority, it wouldn't be enough seats to be filibuster-proof. So back to the market. I think what you're seeing is a combination of the political uncertainty, a belief that the market rebounded too high too fast, and a virus that is picking up steam as we enter the colder months across most of the world. When you consider all of this, I think it's easy to see why the utility sector led over the past month. And with continued gridlock in the government likely to remain into the near future, there are fears that the economy won't be supported like it was at the beginning of the pandemic, which even then still didn't stop a lot of companies from going out of business or keep a lot of people from becoming permanently unemployed. And unfortunately, that gridlock and the virus concerns will likely to continue through early next year, so it's looking like the market could be in a precarious position as it assesses the economy and likely why there's been a move into the utility sector that we've been talking about. While nobody knows what will actually happen, like I said, I never expected to see such a quick rebound from the March lows. The signs are out there that these factors will continue to weigh on the broader market, which could result in the market trading in a range at best and lower at worst. Or I could be dead wrong and it just explodes. But I just don't see that happening. I would just recommend that everyone needs to take inventory of their time horizon and risk tolerance and make the best decision they can make for themselves. The worst thing to do is to look at the data and then make a response that actually ends up being too late as the next market move is beginning to happen. So it always makes sense to diversify to a point so you're not always chasing where the market is going, but already have a position in a sector where you can get in on the initial upswing. So if you think investing in utilities makes sense for you now, I would still caution in not going crazy by going all in on them. Anyways, that's my take. What do you think? Do you agree or disagree? Let me know in the comments. And remember, I know we're in the middle of the most heated election most of us have ever seen, but please remember not to make political shots in the comments. I really want this channel to be above that. And up to this point, I think we've all done a good job with that. And with that, I hope you enjoyed the video, and if you did, please hit that like button and share with your friends and on any of your social media sites and forums you're on. Anything you can do to help me grow the channel is greatly appreciated. And if you're new to the channel or just an occasional visitor, we'd love to have you join the community. You just got to press that little red subscribe button. We'd love to have you on board. Until next time, thank you for watching and have a great day.